non-US pensions in the US, how are they treated? How are they taxed? Well, really, that is a question about DTAs, double taxation agreements. Double taxation agreements are just bilateral agreements that countries enter into to clear up how their respective citizens, residents, are going to get taxed in each other's country. It's to try and avoid matters of double taxation. It's important to note, though, that DTAs do not eliminate all double taxation. They hopefully do, and hopefully they at least mitigate it, but they do not eliminate all instances of double taxation. Something that's an important point that's often missed or misunderstood. So you have a non-US pension. The first thing to do is to establish, is there a treaty from the country where that pension is with the US? If there is, the second thing is to ascertain if that pension qualifies as a pension under the terms of the treaty. It hopefully does, it usually does, but there are instances where a vehicle that is considered a pension in that other country is not considered a pension under the terms of the treaty. Therefore, you cannot treat it as a pension in the US. It's really important to work with a tax advisor to that end. Let's assume that it is. What then? Well, you can probably, although again it's specific to the treaty, apply some of the common fundamentals of a pension, which is gross roll-up, which is where assets grow and tax-free within the wrapper, within the pension, and there's no tax on the dividends and coupons, income. Distributions, once you reach a certain age, are taxable as income, and maybe non-US investments are advisable or not inadvisable. So I'm referring to, of course, PFICs here, a topic for another video, but generally US people want to avoid PFICs at all costs. But within a pension, within a recognized pension, you may benefit from some protection, which allows the investment in PFICs, which for people who have got pensions in pounds or euros or other currencies can be a major attraction. A final note on that is that treaty relief may need to be actively claimed on your tax return. It may not, again, question for a tax advisor, but don't just assume because there is a treaty, because your pension clearly meets the terms of a pension, that therefore you just benefit from the treaty relief, as it's known. You may have to actively and annually claim it. So, what if there is no treaty? For example, Hong Kong. Hong Kong does not have an income tax treaty with the US. You've worked in Hong Kong, you've built up a Hong Kong pension through your employer, you've moved to the US. What now? Well, as there's no income tax treaty, the US does not see it as a pension. Therefore, you are going to have to disclose and tax this asset differently. How depends on how it's structured. So again, important to work with a tax advisor who understands this stuff, but it's probably not going to be treated as a pension like you would expect. Another example of something similar happening is when you have a pension that isn't actually a pension. We've come across clients who have worked in various places and they have a savings vehicle that's been set up by the company. It looks like a pension vehicle. It's even called a pension. Your employer contributes to it, you contribute to it, but it's not legally organised as a pension under any country's laws. Therefore, there's no double taxation agreement that applies to it. There's no. It's not a pension in any country. Therefore, it doesn't qualify as a pension under any double taxation agreement. Therefore, you have to treat it as something else. These are traps that people can fall into, and you should be aware of. A final note on treaties is we've talked about income tax treaties, and this is certainly relevant for how a pension and other assets are going to be treated in the US. There are other treaties that exist. I'm thinking of estate and gift tax treaties, which deal with tax on gifts and tax on death, and totalization agreements, which is how Social Security, national insurance, these kind of things are to be treated and whatnot. And these are separate treaties, and the existence of a double taxation agreement does not guarantee the existence of any of these other agreements. So we'll maybe talk about that another time. So in summary, non-US pensions, it really is a question of double taxation agreements, and there's more to double taxation agreements than just does one exist. That's a starting point, but there is more to it than just that. And you also need to perhaps look under the bonnet of the asset just to make sure that it even is a pension.